My name is Nasser Sanousi. Okay, recording in progress. Assalamu alaikum. Good afternoon, and thank you for joining us. My name is Nasser Sanousi. I'm the Senior Director of Marketing and Corporate Communications at Boursa Kuwait. At Boursa Kuwait, our commitment goes beyond listing securities and facilitating trades. We are dedicated to building a stronger capital market and empowering investors to participate with confidence. Following the rollout of Kuwait's ETF framework, today marks an important next step, moving from regulation to real market growth. Building a thriving ETF market requires more than just rules. It takes an active ecosystem, connecting issuers, market makers, brokers, and regulators. In this session, we want to look beyond the basics and explore how the ETF ecosystem works behind the scenes, what truly drives liquidity and trading activity, future growth opportunities for Kuwait, including Sharia-compliant and active ETFs. We are delighted to partner with CFA Society Kuwait for this event. To open today's session, I would like to introduce Ms. Sarah Abdulsamad and extend my congratulations on her recent nomination as President of CFA Society Kuwait. We are also pleased to welcome our keynote speaker, Anthony Sassin, CEO of Ocean Invest and Nukoud.com. Now, I would like to hand the floor over to Ms. Sarah Abdulsamad to open today's discussion. Sarah, the floor is yours.
Thank you, Nasser. Hello, everyone. My name is Sarah Abdulsamad, the President of CFA Society Kuwait. It's my pleasure on behalf of CFA Society Kuwait to welcome you all to today's webinar held in collaboration with Boursa Kuwait. Our partnership with Boursa Kuwait started in 2019, and it has evolved from collaborations on financial literacy initiatives into a strategic partnership that delivers lasting value to investors, finance professionals, and the broader market ecosystem. At CFA Society Kuwait, one of our core objectives is to contribute to the development of the investment profession, increase financial literacy, and to support stronger and more informed capital markets. We believe that knowledge sharing, professional dialogue, and access to global expertise are essential parts of that mission. Today's discussion about building an effective ETF ecosystem is especially timely and relevant for Kuwait. A few months ago, in June this year, the Capital Markets Authority issued Resolution number 80 of 2026, introducing the integrated legislative and regulatory framework for ETFs. Globally, ETFs have transformed the investment landscape. They have become powerful tools for diversification, efficient market access, and portfolio construction, serving both retail and institutional investors. But a successful ETF market is about much more than the product. Behind every liquid, trusted, and sustainable ETF market is an ecosystem. There are issuers designing products that investors actually need. There are market makers providing liquidity, brokers bringing these products to investors. There are exchanges providing the infrastructure for transparent and reliable trading. And of course, there are regulators establishing the framework that provides transparency, investor protection, and confidence. So if you want to understand the future of ETFs, especially in markets such as Kuwait and the broader GCC, we need to look beyond the ETF itself and understand the ecosystem that makes it work. Therefore, we are very pleased to have with us today Anthony Sassin to discuss this topic. Anthony is the co-founder and CEO of Ocean Invest, a financial services firm headquartered in Abu Dhabi and licensed on the Abu Dhabi Securities Exchange, ADX. At Ocean, Anthony leads strategy, operations, and global partnerships with a mission to build the Gulf's first Tier 1 ETF ecosystem through market making, liquidity provision, and cross-listing solutions for international issuers. With over 20 years of experience in asset management and more than 12 years in ETFs, Anthony is recognized as one of the region's leading ETF strategists. He previously served as head of MENA and senior investment strategist at Crane Shares in New York, where he spearheaded the firm's expansion into the UAE and Saudi Arabia. He was a frequent guest on CNBC, Reuters, Asharq Bloomberg, and Al Arabiya. Anthony holds a master's in global finance from New York University and Hong Kong University of Science and Technology, and a BS in finance from the University of Massachusetts, Boston. He's a CFA charter holder, and he passed the Kaya Level 1. Anthony, thank you for joining us. We are very pleased to have you with us, and we look forward to learning from your experience and perspective. Just a quick note to the audience. At the end of Anthony's presentation, we'll open the floor to Q&A, so please feel free to write your questions in the chat box or the Q&A section. With that, I'll hand over to you, Anthony. The floor is yours.
Hi, good afternoon. Thank you so much for having me, and congratulations, Sarah, on your appointment. I want to thank you and thank the CFA Society and the Boursa Kuwait for having me. ETFs have been a great tool for investors across the globe, and we are dedicated to growing the ETF ecosystem across the GCC. I'm going to share a presentation we're going to go through. This presentation is deliberately technical, based on the ask to go into the ETF ecosystem. And, bear with me and please feel free to ask any questions. The goal here is to break down everything that happens after you push the buy button at your broker and get your exposure through an ETF. So basically, for investors, ETF investing is very simple. You just go to your broker, you select your ETF, you press buy, and within seconds you have exposure. Basically, buying the SPY ETF gives you exposure to the top US 500 companies, just like that. One ticker, one trade, immediate portfolio exposure. Sounds simple, right? But behind the scenes, the trade sits, there's a huge network of issuers, AP, market makers, exchanges, custodians, that make this transition seamlessly and possible. But perhaps one of the best innovations for the ETF industry is making this so simplified. But in the process, they have created a system behind the scenes that is a lot more complex, where a lot of institutions are going to have to collaborate and to make this transition seamless, and your experience buying and selling also affordable and immediate. I've spent 20 plus years in the ETF industry, asset management ETF industry, between the US and the last 2 years in the GCC, moving to Abu Dhabi. Basically, I spent the last 4 years trying to get ETFs cross-listed from the US with my previous company as head of MENA. After 4 years of conversations, we kind of realized that the ecosystem in the Middle East needs strengthening. So that's why we created Ocean Invest. Basically, Ocean's mission is to strengthen the ETF ecosystem across the board, starting with ETF market making, liquidity providing, authorized participant, and also advisory on ETFs, helping issuers create new ETFs for GCC investors. Also, we created a second company called Nukoud.com, which you can access immediately and see wealth of information and data on ETFs from a GCC perspective. The Nukoud's mission is to educate and help investors keep in touch with what's happening with ETFs, what ETFs are launching in the Middle East, how can they get exposures, and how can they build portfolios for long-term wealth creation. ETFs are becoming the main tool globally, from the small retail investors all the way up to the biggest institutions, invest, build, and manage investments and risks across the globe. This slide is deliberately complicated. I just wanted to show you what it means, what goes behind the scenes. I'm not going to take you through this in arrow by arrow, but the goal from this presentation is to break down this slide and make it more understandable into few main topics and few main sections. You can think about this whole chart here, or the ETF ecosystem, into three main layers. The first layer is the product layer. This is where the issuer or the sponsor issue the ETF, working with a slew of vendors and ETF ecosystem stakeholders, such as index providers, thinking of MSCI, FTSE, legal representatives, administrators, custodians. All these collaborate to design and make products available for you to be able to invest in it. The second layer is the primary market. This is the layer that actually differentiates ETF, and it makes all the difference when it comes to the flexibility, transparency, and ease of investing, mainly through a process called creation and redemptions, where authorized participants lead the way. And this is the main tool where arbitrage can happen, so ETF prices can stay near fair value. We'll discuss more shortly. The third layer is the secondary market. This is what investors experience. This is your broker, your exchange, and also the market maker, which is providing the codes, the pricing, the bid and ask, and the size that you can transact on a daily basis. All this is bound by the regulator that makes this whole process run seamlessly. You have regulations related to ETFs and the products and how issuers can market and sell these ETFs and how can they protect investors. You have also regulators authorizing authorized participant to operate in certain markets. Also regulators providing market making frameworks and also licensing market makers, and also regulators monitoring the market, making sure everything is running efficiently and as it should be to protect local investors in the GCC. Before we go into the ecosystem, I just want to show you what's the hype behind ETFs. I mean, this ETFs was first started in 1990 by a product SPY by State Street. It was meant to track the S&P 500. So basically, before the 1990, in order to invest in the S&P 500, you had to go in and put in 500 transactions. Or you could have invested in a mutual fund, which trades once a day, and it's not as transparent as liquid. Price discovery is only once a day at 4 p.m., and fees are much higher. After that, we've seen a tremendous growth in ETFs, starting from moving from indexes to fixed income to sector exposures. Now we're looking at thematic exposures. We're looking at exposures that include derivatives to generate income, basically also exposures mimicking private investments through pre-IPOs or through private equity-like investments, REITs for real estate. The sky is the limit, really. And every year we see a new innovation. And that has driven the market to reach now $23 trillion in assets over the past 20 plus years. This is a staggering, this number, and it's increasing as you can see in the chart here. Currently, as of end of August, the ETF industry has more than 23 trillion in assets, over 17,000 different ETFs in 85 different exchanges across 60 more countries. Also, the ETF industry has seen 85 consecutive months of net inflows. Basically, for the past 5-6 years on a monthly basis, every month, the ETF industry is adding assets, not just through price appreciation, but actually through investors shifting assets into ETFs, gaining market share over mutual funds and other investment vehicles, and also gaining more ways and providing investors with more tools to get access, manage their risk, and build long-term portfolios. Looking at the region, we're still a little bit behind the global ETF industry. And that's why technically ASEAN and Nukoud were created to help push the Middle East into an ETF industry that is more mature, growing just like the ETF industries in the US, Europe, and Asia. Across these three markets, we have 17,000 ETFs, as I mentioned, 23 trillion, 15 trillion of that is in the US, 4 trillion is in Europe, and then another 2 trillion in Asia Pacific. And there's more in other markets like Canada and others, Australia. But also, if you look at the GCC, we're still in the beginning stages. Only 43 ETFs across all the GCC, mostly focused in the UAE and Saudi, and one or two ETFs in Qatar. And the total value is less than $9 billion out of 23 trillion. And a lot of that is due a cross-listed ETF from the US called KWEB, which accounts for more than 80% of that value. So you see, we have a lot of work to do in the GCC, and we're happy to assist all the exchanges, the regulators, asset managers to help build a healthy ecosystem so local investors in the GCC can access ETFs in their local time zone, local currency, without having to go and invest in US and Europe and be subject to things like taxes and time zone differences and other FX related costs that can detract from your total return. So far this year, ETFs have added $1.3 trillion in assets. That's huge. That's almost the market cap of the Abu Dhabi exchange. Basically, in the first 6 months between January and May, ETFs added in Abu Dhabi Stock Exchange. And this is another 40% growth from last year. It's accelerating. And we're still, expecting to see a lot more growth. Many expect the ETF industry to reach 30 trillion in the next 2 years. So basically in the US, one of every 3 shares traded on the New York Stock Exchange is an ETF. So it's almost catching up with stocks. So the growth is amazing. And we still have a lot of work to do in the GCC to catch up with the global industry. Going back to that complicated chart, we're going to break it down piece by piece into the 3 layers. And the last piece is going to be about the investor, you. So stick around. The first part of the ecosystem is the product layer, as we mentioned. You see the red box on the left, which includes the ETF issuers and everybody that works with the ETF issuer to make ETFs available on the exchange, and most importantly, assisted in running smoothly and making sure you are getting the shares in a timely manner, the reconciliations happening, and then the NAV is accurately reflected on a daily basis so you know where your investment stands. The ETF issuers sit at the center of this whole ecosystem. Basically, this is the cooking kitchen. This is where the product is designed, it's launched, it's operated, and managed by portfolio managers within the issuer. When you think about issuer, think BlackRock, think State Street, think KIC, NIC, Markaz, some of these great institutions that are in Kuwait. These are the asset managers that will be launching ETFs for you to be able to invest in. But a lot goes behind the scenes. ETF issuers partner with a lot of external vendors like custodians, administrator, and others to make this process seamless. There are more than 5 or 6 different partners that ETF issuers have to partner in. This is what we call the engine. This is where the operational part of the ETF happens on a daily basis, which tries to run smoothly, building NAVs on a daily basis. So the fund administrator is where the NAV is struck on a daily basis. Basically, it reconciles all position and cash and produces the fund official price at the end of every day. And that price fluctuates during the day based on market action. And then at the end of the second day, there's a new NAV struck. And the NAV, the difference between today's NAV and yesterday's NAV is your actual return. Accounting is where portfolio tracks transactions, income, expenses, corporate actions, dividends, many things that could impact the valuation of the ETF. Custodian is where your assets are custodied and safe kept. The transfer agent plays an important role, especially in the primary market. This is where the creation and redemption happens. Also, this is where the registry for the shareholders is maintained. Transfer agent work closely with authorized participant and the fund issuer to make sure creation or supply is created for ETFs or share units as needed or taken away from the market also as needed. The last part is about distribution It's a broker-dealer that helps with the selling of the ETF. Also, distribution can be internally within an asset manager. This is basically an army of salespeople knocking on doors, having calls, running through a marketing campaign to make sure you're constantly informed about the ETF, about the market conditions that the ETF cover, and keep you informed as you make your investment decisions. Scale matters in the ETF business, but there's a lot of opportunities for niche ETF players. We've seen over the past 2 months, two big transactions by Goldman Sachs, one buying an innovator fund, and these guys specialized mostly in buffer ETFs, which is another innovation. Basically, buffer ETFs mimic structured products, which is a very popular investment in the Middle East, where you can invest in an ETF and have a cap on the downside, but then also your upside is capped. There are different iterations and different designs that are in the market, and these are growing in a big way. Also, we saw another investments from Goldman Sachs into NEOs, also another niche ETF player that started 2 years ago, and now it's just taken by Goldman Sachs. The three big players globally, as you know, are BlackRock, Vanguard, and State Street. We all heard about the three big major giant ETFs in the world, VOO, IVV, and SPY, all track the S&P 500. Together, they form more than 3 trillion in assets of the 23 trillion mentioned. One of them is above 1 trillion. I think VOO just crossed the 1 trillion mark for the first time ever. So basically, the ETF industry is now run by three big ones, but we have a lot of different issuers, up to 1,000 globally, that are coming up with new innovations and new ways to invest through ETFs every day. The second part of the ecosystem is the primary market. And this is really the major differentiation between ETFs and mutual fund. And this is actually what makes ETFs so valuable. The primary market, the main player there is the authorized participant, who, as I mentioned, through creation and redemption, can create units or redeem units as needed. And this creation redemption process, allow for two main things. One is arbitrage, which tends to keep the price near its fair value. And then the second is the efficiency in the ETFs, because in the US at least, transacting in a fund, buying and selling, triggers tax liabilities, whether capital gain or income. And through the creation redemption, everything happens in kind. Therefore, it's like the fund does not have to sell internal holdings to be able to create units or redeem units, which makes it very tax efficient from an investment perspective. This is the creation redemption that we just talked about. The authorized participant is involved basically in creating the units. We'll talk in a second how this happens. And they work closely with a transfer agent that delivers the basket to the fund and the exchange, and then for a block of new ETF shares are created. Typically, they range from 25,000 shares to 100,000 shares. So ETFs units are not created one by one. ETF is a basket of stocks. They're created in blocks. And these blocks are passed to the market maker, who holds them as inventory and pass them to investors as they buy and sell in the open market. And the final part, this helps with the arbitrage loop. Basically, if the price of the ETF diverges a lot from the fair value, participants or market makers can go in and buy enough of these ETFs at the market price. Let's say it's well below NAV, and then redeem it at NAV, making immediately the spread, the difference, and then bringing the price of the ETF back to fair value. So who's the authorized participant? Basically, an authorized participant plays a very important role. It's a financial institution, it's a broker-dealer, it could be a market maker. Austrian is an authorized participant and registered authorized participant in Abu Dhabi. So this license permits the authorized participant to create and redeem unit shares directly with the fund. The authorized participant interact directly with the fund, directly with BlackRock, with State Street, with KIC, with NIC to create these fund units. So basically what happens is that the authorized participant will go to the market and buy the basket, or also they can deliver cash directly to the fund. And then the fund, the transfer agent, will transfer this basket to the fund, and the fund will return back to the authorized participant or to the transfer agent a share unit, which makes its way at the end to the market maker and to investors. And this happens back and forth. This is basically a diagram of the specific steps that you see in creation and redemption. On top is a creation. Basically, you have investor demand. They come in with a big order into the market. The market maker looks into their inventory. If they have enough inventory, or if there's transactions happening in the market from others who want to sell, then that's fine. This happens at the secondary market. But if not, then the market maker turns to the authorized participant and asks them for a creation unit of specific ETFs, which is basically, as we said, 20,000 shares to 100,000 shares. The authorized participant will trade with the fund, will send cash or the actual basket to the ETF fund. The ETF fund will create a new unit which will trade on the market. The redemption process, which you see at the bottom, is the process exactly in reverse. When we have too much inventory on our books as market makers and we want to return it, we send the ETF shares, we put in a redemption order, and that goes to the ETF fund. The basket and cash are delivered, and then the hedge is unwound by the market maker, which is designed to limit the risk of when the trade is happening and when the market closes. And this allows also for the core arbitrage principle, which we discussed earlier, and which is central as very important to the ETF ecosystem and the ETF process. The second part of the ecosystem, as we mentioned, third part here, is the secondary market. This is what you as an investor experience directly. This is dealing with a broker, which routes the orders to the exchange, and in between sits the market maker that is providing codes and size and transacting with you, or you're transacting with other investors that are sending opposite orders to the exchange. This constitutes from three main players and the market maker. First of all, the investor yourself. This could be a retail investor or institutional, like a family office, sovereign wealth fund, a pension fund, etc. And so basically the investors goes on the brokerage account that they have. Some of the brokerage included here with the highest volume on the exchange, KFH or NBK or others. You put in the order, and that order routes to the exchange, which is the Boursa Kuwait. The Boursa Kuwait receives your order, and then this is when they start compiling an order book. The exchange plays a major role in organizing and making sure the ETF process and investors and buyers and sellers are able to meet in the exchange. The exchange has many functions, very, very vital to the ETF ecosystem. It's the ETF trading hub. It's where everything happens. Basically, on the exchange is responsible for listings. They are the ones who are evaluating the fund, taking the application from the issuer, who's looking to list that ETF on the exchange, giving them approvals, making sure they're launching and operating smoothly. The exchange is the party that compiles the order book, basically all the buys and sells that are in the market, whether through market orders or limit orders. The exchange also has the market data, and all this market data is very important for market makers and others to be able to operate. And they provide this data as well to other data providers, so you can see it on different websites and different outlets like Nukoud. All this data is driven by the exchange. Also, the exchange design the market making framework, license market makers, and make sure they're operating within the license and within the requirements that they are supposed to. Also, the exchange provides market controls and surveillance, which is very important. making sure that there's nothing unusual happening in the market, disadvantaging any investors. The post-trade is also essential here because this is where everything is tracked, where trades are compiled, recorded, settled, and delivered to the investor. Basically, this is an order book from today's market. It's an ETF listed on the Abu Dhabi Stock Exchange. This is, basically the exchange prioritizes quotes out there that have the best price for investors. The yellow part are the orders that have the best price out there. Basically, you see the first order on the left, 421 shares at a bid of 2.37. And then you have two other orders of 5,500 shares, 5,900 shares, also at the same bid total. And the ask on the other side, which is 2.39, also you have another 5,000 shares. So basically, you can transact in the market at these prices currently. You're able to buy at 2.39, which is the ask, or you're able to sell at 2.37. All the orders below it you see in blue are other orders, limit orders, put at different prices, outside where the bid and ask is. You see the first one right after the yellow on the left side is 2.36. So basically, when the 2.37 are done, or when the market moves, then the 2.36 goes back to the yellow section, and the same thing on the ask side. So this is what we call an order book. Not everybody can see it. Only market makers and few players can see the order book that is happening in the market. And this tells you where are the orders now and at what price and at what size. So this is a very important part that is managed by the exchange. Now, the market maker. Basically, Ocean Invest is a market maker. And the market maker's job is to facilitate liquidity for all the participants in the market. Basically, the market maker job is to price the ETFs, which is not easy to do, especially if you're doing international stocks or international securities that are off markets. Currently, we're pricing ETFs from the US. The US is closed, so we have to find other proxies or price through futures and be able to provide an accurate price and commit to that price in the market. Because once you click buy or sell, we have to take that order, and these shares would be for us, would be in our balance sheet, or we would be selling you those shares. So pricing is very important. Once we price and buy and sell, then now we're holding a book or an exposure of different ETFs. Think about market makers managing 100 ETFs at a time, and buys and sells happening all the time, every second across all these 100 ETFs. Basically, the market maker has a very complicated book to manage. And the way this is managed is through hedging, which is a very important part, making sure that the book is as neutral as possible as it can be to market actions. And in today's market, volatility is high, prices can move, and different ETFs can move more than other ETFs. Basically, investing in an AI or technology ETF can be subject to much bigger movement than investing in bond or Sukuk ETFs, which volatility is a lot lower. So basically, a market maker here is providing that liquidity and also making sure that they're able to maintain the spread and hedge it, and also they're able to maintain high market quality based on the requirement of the exchange and the regulator. This is basically the main four functions of a market maker. Pricing, as we mentioned, these are models that run on the ETFs. Basically, every morning we get something called a PCF file, which is the detailed holding of every ETF we cover with pricing from the issuer, from the ETF sponsor, and those PCF holdings go into our models that generates a price of something we call fair value. Okay, and based on that fair value, this is the code we quote in the market, the bid and ask. You see on the right, this is a picture from Interactive Broker. of a KWEB ETF that is listed on ADX. And you see the red highlighted in the red square on the right side. You see ask bid. You see 1,000 times 99 point something for the ask, and also bid 1,000 times 99 point something. Sorry, my screen is covered here. But what that means is we are offering this ETF. We are offering to buy it at the bid, which is the price is 99, and we're offering 1,000 shares. And we're offering to sell you the same ETF at 99.30, also 1,000 shares. You see here there's a spread of 30 basis points. This spread of 30 basis points is basically what we think reflects the risks in the market. And we'll talk about the different components that go into that spread. But this 1,000 share is not just selling you 1,000 share and done. This 1,000 shares gets replenished every time. So basically, if you can go in now and put an order for 10,000 shares, and then you can execute it at these prices or slightly higher based on the order book that you see before. So this is the main job of a market maker, is to quote on the exchange and continuously quote throughout the day. These prices, our fair value updates on it every second based on the movements of the underlying in global markets, whether the stock itself, if it's closed, then you have the future. If that's not reliable, then you have a proxy that actually mimics the price of the underlying. Also, basically, our third function is to hedge, as I mentioned, to offset the ETF exposure using either a basket exposure, basically the underlying investments. We're using futures, swaps, or different ways to make sure, as I mentioned, our book is neutral as much as possible to price movement. And the third part is arbitrage. So basically, we participate in the arbitrage. We have an idea of where fair value is. And when we see the price of the ETF is diverging from fair value, we can buy enough shares in the market so we are able to redeem or create units based on if it's selling or buying. Okay, so as we mentioned earlier, every creation unit is between 20,000 shares to 100,000 shares, depending on the ETF. And that's usually set by the ETF manager, by the sponsor. So if it's, let's say, 30,000 ETF, we see the price is off, we can buy 30,000 shares and redeem that ETF unit. So the fair value is where the actual price is. There's a lot of exchanges can offer INAV. INAV is also computed by a third party. They do almost the same process as we do. They have their own models, taking the underlying and also pricing where the underlying is times the weight, coming up with a fair value. However, the problem with INAVs is that many markets are closed. If you open up the INAV for SPY now, or KWEB, which is trading on the US, on the Abu Dhabi Stock Exchange, you can buy it now. Many of the holdings, underlying holdings like Alibaba and Meituan and others are listed in the US, and the US is closed. So there's no price movement. So this, and the INAV is not able to give you the right fair value because the market is closed. Sometimes they use futures, etc. But they're not as sophisticated as a market maker. Market maker have more technical and quantitative abilities to be able to price these underlying stocks more accurately, even if the market is closed. This is what makes this function very technical and very important and very delicate. And that's why we created Ocean, because we felt that this specific function is very much needed in the GCC, especially for pricing international ETFs and during market close. So what goes into the fair value or into the bid-ask spread, which is on top of the fair value, is the basket price, what it is. The futures, are we able to find easy futures? If you're looking for something like ACWI, yeah, there's a future that trades and tracks ACWI. That's simple. If you're looking for something in active fund in AI, that's a different story. Now you have different companies from different markets and different countries that makes the process of pricing in a little more unpredictable, a little more uncertain, and you will see that reflected in the spread. FX also is very important. If you have exposure in markets that are volatile, that also adds to the spread. If we're looking at US companies, US and the GCC, different countries, they have a peg. There's still some friction in terms of conversion, but the currencies are pegged, and you have some kind of an indication on where that currency is going to be. If you're looking at something like Europe, where you have no peg, as the euro moves or as the British pound moves, then the FX and the underlying price is moving. That adds complexity, adds risk, and adds to the spread. Market hours is also important. We have some ETFs that we track that are based on the European markets. The European markets open at 11 a.m. Abu Dhabi time. Before that, it can be a little bit hard to price it. So you may find spreads for such ETFs to be a little bit wider before 11 a.m. And then they tighten after 11 a.m. after the market opens. Same thing for US, but for the US, because it's a much bigger covered market and you have different ATS, which is dark pools. I don't want to get into that specifically, but these are pools that are trading overnight. They're not very deep yet or broad, but they're developing. Also, the NASDAQ just announced that they're going 24 hours starting in December 6th. That would help us a lot because now there's more price, these stocks are moving, then we're able to price more accurately, and the risk is lower and the spread is lower. Also, the funding cost there's no unlimited capital with anybody, right? So basically, we have a specific amount of capital that we're deploying to provide liquidity. And we have to be selective, and we have to understand the funding cost. And if the funding cost is higher, that means the spread is higher and the risk is higher. Volatility is another big component, as I mentioned. If you're looking at market making Sukuk ETF or bond ETF, the volatility is a lot easier to handle. But looking at an AI ETF, especially in today's markets, where you have a lot of interference from the US market, one day Trump is supporting quantum, the other day he's having a fight with one of the companies. These are impacting prices in a big way, and you see big moves that can move overnight, 3, 4, 5, sometimes 10% in some of these stocks. So basically, the spread is going to have to account for that risk. Okay, and that's what constitutes a bid-ask spread, as we showed earlier. Ideally, the bid-ask spread would be around the fair value. Basically, the fair value is 100. The bid would be a little bit lower, and the ask would be a little bit higher. And that spread would be 20, 30 basis points, 40 basis points. It can go up to 1% if the risks are high, the funding costs are high, uncertainty is high. Now, moving on to the fourth piece of the ecosystem, and that's the regulator, right? The regulator, as you see, it's in the middle, binds everybody and regulates everybody. It has arrows going to every single part of the ecosystem. Arrows going to the ETF issuer, arrows going to the broker, to the exchanges, to the market maker, etc., and even to the investors. And the goal here, one thing, is to make this operation run smoothly and to the benefits of the investor. The biggest role of regulators is to make sure the investor is protected and things are running smoothly and no operations are happening in the market that could disadvantage an investor. As you see here, the CMA, your CMA, Kuwait CMA, which just passed the ETF framework or the ETF law or approved it, which was passed by the exchange and approved by the CMA. Basically, this is one function that the regulator enforces. Their first is fund regulation. Okay, they approve the products, they make sure the assets are eligible, they're liquid, they make sure that the issuer is able to meet liquidity on a timely basis, which is usually T+2. Make sure that the underlying assets are liquid. The risks are detailed and disclosed, so you know exactly what you're investing in. The valuation is accurate. The second part is the market regulation. This is where the CMA works hand in hand with Boursa Kuwait to make sure that the trading is conducted well. The market making is working as requirements. The surveillance is effective and able to catch any irregularities, and working with the exchange rules like the ETF market making framework. And this is just one part of what the exchange has to do here. You have the derivatives, you have stocks, you have many different aspects of trading that the exchange has to regulate and work with the CMA to get it approved. Also, they regulate the brokers, the custodians, they provide the licenses, they make sure these institutions are operating and they have the right people and the right framework and processes to make sure that investors are not disadvantaged. And the last one is investor protection, making sure everything is transparent, it's suitable for you as an investor, there's no conflicts and there's fair dealing, there's no insider trading, etc. Now, the last part of the ecosystem is the investor yourself, and this is very important. Without the investors, all we just discussed won't make sense. Without the investors trusting the market, looking to invest and using ETFs in their portfolios, providing or generating demand, then the ETF ecosystem is going to be, is the ETF industry is going to be on the weaker side. So the investors has to be involved and informed and understand that ETFs is really an integral part of building wealth and managing investments and managing risks. And really ETFs at the end of the day benefits firstly the investor. Before ETFs, many of the strategies that you see today that you can just do and invest in a click of a button and pay between 50 and 75 basis points, sometimes 1% for a fee. These strategies used to be exclusive to institutional investors through hedge funds and other sophisticated investment vehicles. ETFs have simplified all of this and made it accessible and lower cost and made it transparent for investors to be able to access and build their exposures more efficiently and more affordably. Let's go. So basically, one thing you hear or you see on the investors' top concern, whether institutional or retail, is liquidity. What we see on the screen is that the only liquidity that is available, and the answer with ETFs is no. This is the biggest misconception because of the different layers that you see in the ecosystem between the primary market and the secondary market. There's a lot more liquidity and volume than you see. First, you see on the screen, as we showed earlier, there's 1,000 shares offered at 99. These shares continuously replenish. So basically, it doesn't matter how much inventory we have, and we can keep selling. If you put a 10,000 order or a 50,000 share order or 100,000 share order, the market maker should be able to provide to help you execute that trade. Now, so there's beyond the screen, especially for institutional investors, something called RFQ process, where an institutional investor can call directly a market maker and say, hey, I'm about to put a big trade, and I just want to make sure I'm getting the right price. And this is where negotiations happens, and institutional investors can make sure they can get in and out efficiently. In addition to the market maker, there's the AP creation process and capacity. And as we mentioned, although there's not enough shares of ETFs on the market, we can easily create. We can do 100 creates. If each creates as 100,000 shares, you do the math. This is plenty of shares to be traded on the market. And all the ETFs where they derive their liquidity is from the underlying stocks, really. So basically, whatever the underlying is liquid, then there's no issue in trading the ETFs, especially when you're talking about US ETFs or markets that are deep, like US, in Europe or in Asia. Basically, you're buying, let's say, QQQ, which invests in Microsoft, Apple, Amazon, Meta, you name it, NVIDIA. These ETFs trades millions and millions of shares a day. So it doesn't matter as much as you want from QQQ, it doesn't matter how much is on the screen, because the underlying liquidity of these stocks will filter into the ETF. So the first misconception is what we see on the screen. Is it just what we get? The answer is no. There are multi-layer here to make ETFs more liquid and available for trading. Let's follow a trade. Basically, on the top side, top line, investor goes in. You go to your broker, you submit the order. The order is routed to the exchange where the market maker is coding. If there is enough shares with the market maker or in the market, then the trade goes through immediately. If not, then this is when we take this little detour that you see lower, where we access more shares from the AP. The AP will contact the fund, will send them a basket of stocks or cash, and then through the transfer agent, the shares will be created on the market. And then you see all the way on the right, after that trade is done, there's a lot more work to do. This is not just it. Your trade will go to the clearinghouse. This is where securities are matched. Basically, buyers and sellers, who's buying, who's selling, if there's new shares created. From the clearinghouse, your trade goes to the CST, where the securities are settled. And then from the CST, it goes to your custodian or broker, where the securities are booked under your name, under your investor name, in your broker account or your custody account. And this all has to happen within T+2. Means if you execute the trade today, the cash goes to the other party, and then you should have the shares in your account settled in 2 days, but your exposure starts immediately, okay? As immediately as you send that trade, your exposure starts, but then you won't have them fully settled in your account until 2 days. Very important to understand the cost of buying and selling. This is very important. We see a lot of investors go in and just put a market order, or sometimes they make mistake and put a limit order way above or way below the limit price. In the markets in the GCC, we've seen limit orders as high as 20% above fair value. So basically, the second that trade is executed, the investor lost 20%. It's very normal to see it 1, 2, 3, 4% above. So it's very important for the investors to be informed and educated and know exactly the price they're transacting on. Okay? So your first cost is the bid and ask spread. That's basically what the market maker is setting based on the risks and the opportunities that I just mentioned earlier, which include FX, basket price, futures proxy, volatility, etc. The second cost is your brokerage cost and the exchange fee, basically, or even you can have a CST fee or other fees, CMA fee, embedded within this. So your exchange may charge you something for that trade. And then in addition to that, there is an immediate charge from the CST or others. And the last thing is premium and discount, which we didn't discuss in this presentation. But basically, if the market maker is quoting above the fair value, basically your fair value is 100, but they're quoting at 101, 101.5, right? That means they're quoting at a premium. So if you are buying at that premium, you are buying at 101 where the fair value is 100. But usually that happens when you have issues in the market. That also it's a reflection of the risk. So the market maker will strive as much as possible to code around fair value unless something is happening in the market that would lead to having some premium or a discount the other way around. Let's walk quickly through a trade that I put it at the bottom. Let's say the investment at 3,000 Kuwaiti dinar, right? The ETF code from the market maker is 100.0 and 100.4. But the actual fair value is 100. So basically your spread cost to go in and out, this is a round trip, right? This is buying and then selling that same security, is 40 basis point. 40 basis point of 3,000 is close to 12 Kuwaiti dinar. And then premium and discount, as you can see here, the market maker is quoting at fair value. So your cost is 0. And then let's say the broker is charging you around 250 fills for each way. That's another 0.5 Kuwaiti dinar. And then let's say you have other fees from the exchange, CMA. Sometimes it can add up to like 5 pips each way, which is another 3 Kuwaiti dinar. So when you decide to make that 3,000 dinar, Kuwaiti dinar investment, in and out, you're buying and then you're selling the same security. Your cost could be on the right up to 15.5 Kuwaiti dinar, which is 50 basis point of your investment. So basically, the first 50 basis point you make on that investment is going for fees. So this is very important to understand, because let's say the spread is wider. It can go from 99 to 101. Then now you're paying more in spread. Let's say the market maker is quoting at a premium. Instead of 100, it's quoting at 99. That adds another 1%. 1% of 3,000 Kuwaiti dinar is 30 Kuwaiti dinar. So it can go from 15.5 to now 45. And now your investment cost is 1.5%. So it's very important to understand what you're trading, and always putting a market order is it can be risky. So limit order is preferred. But also the thing is, sometimes you don't have access to the fair value. And when you have multiple market makers, that makes it a lot easier. Competition will actually remove the premium and discount in many ways, unless, as I mentioned, there's something very clear in the market that is increasing the cost. And also competition can drive lower bid and ask spread. So that's basically the cost for investors. So we just discussed this chart that I just showed you in the beginning that was very complicated. We broke it down into 4 different parts, basically starting from the view of the product of the issuer. What are they thinking? What exposure are they offering? What is the fee? How many ETFs they're launching? All these different questions answered. The second layer is the primary market, where creation and redemption happens. And this is a very important feature for ETFs that makes a big difference between mutual funds. And you can see globally mutual funds are on decline in a big way. And very soon you're going to see them decline even more, because ETF is becoming the vehicle of choice, the wrapper of choice for many investors, from retail to institutional. The third part is the secondary market, which you interact with on a daily basis, but with some things hidden, like what happens with the market maker, but you can see it on the code. And if you're able to understand and read well the bid and ask and the size, then you will know what is the market maker thinking in terms of risk, in terms of size. And then the fourth layer is the regulation, which binds all this together. And lastly, it's the investor yourself, which is very important to this whole process and is going to drive and be the decision maker, whether the market industry or the ETF industry and GCC will succeed or not. Lastly, this is my last slide. What makes an ETF market successful? It's basically these 6 main parts working together efficiently: product, liquidity, access, the infrastructure, regulations, and most importantly, education. Basically, investors knowing about ETFs, what are the benefits, how they can use them, and being able to use them as a tool for long-term savings. You can also use them for speculation, but I would be careful there. ETFs are made to get investors long-term exposure in a very easy way and a cheap way. So I hope this has been helpful. This is kind of an overview of the ETF ecosystem. I mean, there's a lot more things that we did not cover, where we can get into more details into every step of the way. But as you see, it's a complicated web of stakeholders and partners that are working together to help you see at the main page or of the broker, where buying ETFs is very easy. But then in fact, it's a very complex process that takes time and effort and discipline to make it reliable and make it work for the investor. So thank you so much. And I'm happy to take any questions.
Thank you so much, Anthony, for this insightful presentation. We'll move to the Q&A. If anyone has questions, please write them down in the Q&A box. I see a couple of questions have been answered already by Nasser from Boursa Kuwait. Okay, so we have a question. Given Kuwait is T+3 settlement cycle, how do you see the AP creation and redemption mechanism working efficiently in practice, particularly for arbitrage?
Yeah, so basically, having more time can be good and can be bad at the same time because the world is trying to move to T+0. This is where we see tokenization now, a lot of research going into it. But in a market where we're starting, T+3 can help reduce cost and reduce risks in many ways for the market maker and authorized participant and provide them more time to be able to deliver shares. So basically, it is longer, 1 day longer than what you see in other GCC countries, and a couple days longer than the US. But this would work well for ETFs that have international exposure, where the market maker can actually hold off for 1 day. Instead of creating today, they can hold off for next day to see if there are any more trades. But of course, I think at the end of the day, I'm sure Boursa Kuwait is striving to try to shorten that period.
Another question to you, Anthony. Can you shed some light on tracking error? How is the tracking error different from the perceived returns?
Yeah, no, that's a very important point. This falls into the issuer section. Basically, one of the functions of the issuers is to manage the portfolio, and that means buy and sell the different exposures as inflows or outflows come in, and also be able to rebalance so they can track the index based on an index. So an index is the benchmark where that fund is tracking, and ETFs. All ETFs have indices to track, except for active ETFs. And basically, the tracking error is the benchmark or is the KPI that you can track to make sure that the issuer is actually doing what they're supposed to do and are able to give you an exposure that is as close as possible to the index. But in reality, there's a lot of different market conditions and market events that happen that can widen the tracking error, right? FX is one of them. Different time zones is another. So if you're trading US stocks, trading is happening, inflows and outflows are happening during our time, but then the markets in the US don't open till 6 p.m. Or 5 p.m. our time. And so basically that create a mismatch in the time zone, and including other events that could happen from corporate actions, sudden merger and acquisitions, creation and redemption also can impact tracking error because this is you're creating units and basically investing more money into the basket that would become an ETF unit that would track the index. So it's very important to keep track of the tracking error as an investor and make sure that it's low. Now, as I mentioned, in the GCC, it's going to be a little bit higher than what you see in the US. Basically, in an ideal world, the tracking error would be the fee, right? So if the fee is 50 basis points, that should be as close as possible to the tracking error. But as I mentioned, with the different events that happen in the market, that can go up to 1.5%. You don't want it to be above that. Being above that means that you're not now you are not getting the full potential of the benchmark. You're actually behind it by 1.5%. But also tracking error can be a plus. These same events positive as much as negative. But in general, in an ideal world, you wanted to track the fee plus some room for these different market events that I just mentioned.
Thank you. There is a follow-up question on the first question. How important the ability to short ETF units for an AP to perform its arbitrage function effectively? Can an efficient ETF ecosystem operate without it?
No, 100%. It's very right, and you need to be able to short. So in the region, you're able to short, but then you have to cover at the end of the day. So that means you have to go and borrow. Basically, borrow becomes even more important here to be able to cover your short. So if you're not able to short, then you are your exposure is naked, right? And now you're subject to price movements of the market up and down, and that will widen the spreads. And let's say in markets like today, where we have a lot of events happening around us and markets moving in a significant way on a daily basis, it makes it very difficult to be able to market make or even create units and redeem units based on what's happening without being able to short or borrow ETFs. So this is very important for the market to allow shorting. In the US, you can short for as many days as you want. You don't have to cover. Here, as I said, you can short for the day. You have to cover at night. But then when you cover at night, there's a cost. It's like you're borrowing, right? So the cost can vary from 2% to 10% on a specific stock, depending on the demand and supply. And this is annually, right? So you have to divide 2% or 10% by, etc., by the number of trading days, let's say 250. That would give you the cost of borrowing on a daily basis for that ETFs. I mean, if it's 2%, that's still low on a daily basis. It's not very significant, but as you move towards the 10%, that will put a drag or an impact on the bid and ask. So just keep in mind, anything that in the ecosystem that doesn't operate as it should, that means this is added risk. That means this is added cost and a higher bid and ask spread for local investors, right? And this is not something we want. If we want to encourage investors to access ETFs and use ETFs as their main tool for investments, we have to make sure that they're getting in and out at an affordable and reasonable cost. So basically, tightening the screws on the operational part of the ETF ecosystem, optimizing it as much as possible. This will very much land in the benefit of the investor and ultimately in the benefits of the ETF market as a whole.
Another question, on what basis is the creation unit size determined? In a feeder master fund structure, should the creation unit size be aligned with the master fund's minimum subscription amount?
No, it doesn't have to be aligned with a minimum subscription amount, but this is a good question on what is the optimal size for a creation unit and redemption unit. And I say this question is very important, especially for our region. Okay, so basically, if you have, you don't want to be able to create and redeem quickly, like often, right? So you don't want it to be too low. If it's too low, then you're transacting all the time with the authorized participant, and there's an added cost and an added operational process, and also this will impact the fund's tracking error, as I mentioned. So basically, you want to find this level, but also if the creation unit is high and then the demand in the market is not up to that creation unit size, basically what that happens here, let's say this becomes an issue and becomes an added risk on the market maker. Let me give you an example. Let's say I'm buying an ETF that trades, let's say, 50 shares a day, okay, or 1,000 shares a day. Based on its historical average. Today, I'm short 1,000 shares, right? I bought and sell. I don't have as much inventory. So now I look at my book, I'm down 1,000. So now I have to create so I can cover that short. If my creation unit is around 50,000 shares, right? So now I'm left on my books with 49,000 shares extra. And based on history, this ETF is selling 1,000 shares a day. That means I need another 49 days to be able to get rid of that inventory. So that's, as you can imagine, buying up capital. There's market movement. there's cost for hedging. That makes it really difficult for a market maker to be able to provide liquidity for a certain ETF in a correct way, and where spreads are tight, premiums are discount are non-existent, and so that's important to actually study and think about for each market, and then start low in a way that is not, as I mentioned, too low where you're always redeeming and creating, but low enough that the market maker is able to provide liquidity efficiently, especially from perspective of use of capital and cost of hedging.
You have many questions, Anthony. Can you please go over the calculation of INAV during trading hours? I believe you mentioned it's usually done by market makers. CMA requires INAV to be calculated by fund manager or investment controller intraday during trading hours and be posted every 15 minutes.
Yep, exactly. So this is something we've faced here. But then, just so you know, as a major rule, most of the exchanges in the world are moving away from INAV. Okay, New York Stock Exchange, there's no INAV. The Abu Dhabi Stock Exchange will remove INAV, especially for international ETFs, and we'll talk about why. And many other exchanges are moving away. So basically, the calculation of the INAV is very simple. Okay, you're taking the list of stocks, price times weight, and then you just do the weighted average, and you have a price. So this is basically where the INAV is. Now the problem, as I mentioned, if you're doing an INAV on something on the Kuwaiti exchange, then that's easy because the ETFs are trading at the same time where the stocks are trading, and this can be calculated by a custodian or a fund administrator. There are many different, or even an index provider. There are many different. Even Bloomberg is doing it now. There are many entities that can do it, and that's correct. The fund will contract these entities to provide the information. Okay. Now, if the ETF is tracking stocks that are in markets that are closed, right? Now the INAV is irrelevant, right? Because now what you have, like we said, you're taking the list times price times weight, and the price of some of this basket is from yesterday, and the weight is from yesterday because the market is closed. Then your end INAV is not going to be relevant, right? The second part of it, there's data licensing, okay, which we faced here, we saw here, and we throughout our experience working with the local exchanges. Basically, the data that you use in the INAV belongs to an exchange, whether here or ICE or New York, belongs to an exchange. And as you know, as an exchange, the market data is you try to monetize that. So you want to that costs money. So if you end up posting that information publicly for everybody to see, then now you're getting into data licensing, which can cost 30,000, 40,000 a year per ETF. And that's a very big cost for anybody to bear. So that's why you see exchanges all around the world now moving away from INAV. But for the market maker, we have a much more sophisticated calculation, as I mentioned, right? At the end of the day, the INAV or our fair value should be as simple as, like the INAV, as simple as price times weight, okay? But as I said, a lot of these stocks are not trading, so now you have to find a proxy. Plus you have corporate action, plus you have dividend, X day, trade day, plus you have some ETFs that are listed that have private companies like Anthropic and SpaceX. Plus, also you have ETFs now that are based on derivatives. So you can see that the fair value or the price calculation can get very, very complicated very quickly. This is why, what makes us different at Ocean, okay, is our team is based on is coming from the US and the UK. Our leadership, in addition to myself, spent 25 years in asset management. Our head of trading spent 25 years market making at the highest levels at UBS, HSBC, Cantor Fitzgerald, managing more than 100 ETFs at the time with billions of dollars of flows, and making sure all these pricings are working correctly. And especially during different times of the day, as markets are closed, our proxies are tracking correctly. it's a very complicated process. And that's what makes us different in terms of Ocean. We're able to do that process, and we have the team from, as I mentioned, leadership from UBS, HSBC, Cantor Fitzgerald. Our traders are from RBC. We have quant developers, quant researchers from Bevan Howard and different big institutions in the region. So that process can become quickly very complicated, and that's very essential to be confident about pricing your ETFs, because if a market maker is confident with the price, that means the market maker is able to tighten the spread, is able to trade near fair value, because they know exactly they're selling at what price and buying at what price, and how to hedge it. So yes, it's not, INAV is really not a great way of tracking a fair value unless you're trading in the same market at the same time zone. This is where the market maker comes in and is able to provide a much more accurate fair value.
Can you shed light on the inclusion of an index provider when establishing an ETF, and what are their role in the ETF cycle?
The inclusion of an index provider, yes. So it means selecting an index provider for an ETF. It's definitely very important. It's your first step, basically, after you decide as an asset manager what type of exposure you wanna provide. Then your next step is to find that index that provides you that exposure. Sometimes that index is available off the shelf, or sometimes it's going to be custom. But working with big index providers like MSCI, FTSE, Selective, S&P 500 is a great way to start in many ways, especially if the fund is Sharia compliant, because the Sharia screen comes within. But you have to take into consideration that they have very strict liquidity and volume requirements. So basically, if you're going to take off the shelf many of the stocks that trade on the exchange, especially if you're talking about like smaller exchange, may not be included. So now you go into the territory of having a custom index, and that creates another complexity. So it's a process that is very important. It can be complicated. And when you're dealing with, you want to try and deal with a big index provider, but at the same time, they have restrictions. So yeah, it is definitely it's like getting married, right? You want to make sure you're selecting correctly, because that's going to be what your ETF is going to track, and what your ETF is going to be benchmarked on. And this is going to dictate your exposure in the market. If you're too concentrated in one or two or three stocks, then as an investor, I can just go buy the three stocks and not pay a management fee. So it is a complicated process that requires thought and study and shopping around.
Okay, Abi, the next question. Given that some stocks in Kuwait trade are inconsistent liquidity with a wide index network, as it inhibits a market maker from acquiring the basket efficiently?
Yeah, of course. The underlying liquidity is very important for ETFs. And so that's basically will filter into your index, right? So basically, as you're building that index, you want to take that into consideration, and the big index providers will definitely do that for you, but they may have more restrictive rules, and it's related to the expected demand in the market, right? So if you're expecting a certain amount of funds to go into that ETF, then you can try and measure it and make sure you're including the right weights for these stocks that are illiquid. Now, in many ways, also there's another way of managing an ETF based on illiquid stock. Or if you want to track, let's say, the Kuwaiti market, and you have some stocks that are not trading, basically now you get into the area of stratified exposure. So basically what you do is you build a portfolio of the existing that has a very close beta to the market. And instead of investing, let's say, in 100 stocks, you're able to get that same beta with 80 stocks or 85 stocks and adjust it this way. So that's also falls under the issuer umbrella with the capital markets. At Ocean, we also have capital markets advisory. We can run that on behalf of the client because this can be a little bit complicated. Capital markets, at least in the beginning, can be complicated because you can it's a daily maintenance, and you can see events in the market sometimes unforeseen, corporate action, etc., that can actually lead you to deviate from your index. And if you deviate from the index, then an investor evaluating your ETF, seeing a big tracking error, may pause and think about investing because they're not sure if they're going to get the index return. So it's a sensitive, complicated process. It gets easier with time and experience, but there's a lot of different components to it. And it's like driving a car at a certain speed on a daily basis, and you just have to keep going. You cannot just slow down. If you slow down, you're just behind on time, and you're not, your expected time is different from your actual time, which is the tracking error. And and that would cause investors to think about investing in it. But of course, it's a process that needs to be managed internally, or you can outsource it, and it's very important for the ETF and ETF demand.
A question about corporate actions: how to manage corporate actions of shares with INAV on a daily basis?
I'm not sure if the INAV is able to daily basis account for that. I've never had a practical experience calculating INAV specifically, but this needs to be taken into consideration. Corporate actions sometimes can mean the merger and acquisitions. Basically, all of a sudden, one day, the shares of one corporate disappears and appear in a different corporate and under different stock, and you want to be able to manage that. Basically, you're talking also about like when an offer is made, can be made 10-15% above, and then at some point in time, this is going to wind down, and that stock going to stop to exist. It's going to again go somewhere else. So as a capital markets, you want to be able to buy and sell at the right time to sell whatever corporate has been acquired and buy more of the corporate that actually is the acquiree. So it can be a complicated process, but for the INAV, I'm not sure if this is captured immediately on a daily basis.
Okay. In practice, is a market maker a separate person than the AP with separate brokerage accounts, or they can be the same person using the same brokerage account?
So technically, an AP should be a broker dealer that can take accounts. But here in the UAE, a market maker can be an AP if they contract directly with the fund, which is what we're doing. Usually they're separate. They can be the same if a market maker is a broker as well. If you have both licenses, then that's fine. Then you should be able to do both functions. But yeah, these are two separate functions, two separate licenses. Yeah, they're different.
Okay. Without options or futures, how can we hedge to a neutral book?
Well, there's multiple ways. One is the basket. You just go ahead and short the basket, right? But then you're gonna have to borrow at the end of the day, and or you have to find something that is a proxy, right? Like either that tracks the market, closely, or at least identify your beta of what you're using as a hedge, and size effectively, right? So if the beta is 1.2, then you want to buy a little bit more or sell a little bit more. It's a process that takes some quantitative work, a lot of research on the different options that you have to be able to hedge. And it could be as straightforward as buying a future, selling a future, or buying a basket or selling a basket. or it can be more complicated as investing in different assets or different securities that could correlate. So yeah, it takes research. That's why we have two quantitative researchers on our team on a daily basis evaluating hedges and doing research to make sure our book is hedged correctly and we're using the same instruments that have very similar beta to what we have. And these things could change on a daily basis. And like look at the relationship now between stocks and bonds, right? Which is totally very different. Bond yields are going up and stocks are going up in the US, which is very untraditional. So these correlations or these relationships can break, and you need to keep track of it and make sure you're on top of it and able to use the right hedge for your portfolio. Otherwise, you're going to be subject to market.
More questions are coming, Anthony. For a Kuwait-listed ETF tracking an international market that's closed during Boursa Kuwait trading hours, what do you see as the best mechanism for ensuring efficient price discovery and keeping the ETF close to fair value?
Yeah, of course. So that's the job of the market maker. We're doing this right now. We're market making ETFs in the US, in China, in Europe, and in the Middle East. So we're covering all these different markets. And there are ways, but then you have to open, there are ways, but you have to open accounts. It sounds like these questions are coming from professionals in the industry. So you have to speak your language, you have to have access to different markets and fixes to different brokers and different ATSs and, different ways you're able to price, and then you're able to hedge. So that's what we do on a daily basis, but it's a complicated process, and it just takes expertise and someone who has done ETFs in the past to be able to work through that.
From your experience, can you shed light on the treatment of suspensions or delisting of an ETF constituent?
Yeah, this is important. Sometimes you have market caps, like caps on the market. If an ETF moves by 5%, then the market maker cannot submit codes below that 5%. So what that does is it disadvantages the market maker, because first now we cannot code at the bottom limit or the top limit, because now we're losing money. Somebody can just come in and just buy a lot of ETFs shares at that price and then redeem it immediately. Or let's say if the bid is below and the ask is above, then now we have no bid, and now you're in violation, or you don't have both. You're not coding, and now you're in violation of exchange requirements. So suspension is a better way of doing this, and sometimes it's needed. If depending on what the exchange is willing to, the volatility of the exchange is willing to withstand for investors. It can be at 5 or 10%, or but for international ETFs, I think it's an easier decision because US stocks, or they're not going to move in a way where the ETF is going to move more than 10-15%, and that's all driven by the underlying in the US, which are very liquid and deep and not subject to manipulation, right? So basically two parts here. One is your volatility limit for investors. If it's 5 or 10%, then usually 10 and above is much more advised. But then this price is going to show up the next day. So by suspending, you're not doing anything here, unless now your actual underlying stocks within your market are being subject to that downward pressure, right? So if you're seeing a lot of selling on the Kuwaiti market, let's say, by someone that is, the suspension could work there and could stop that selling pressure. But yes, so basically suspension could be a healthy part of the exchange framework, mainly to protect investors from market manipulation or someone just trying to move the price, especially on things that are illiquid. And then in terms you suspend it, it just doesn't trade, right? For us as market makers, we stop quoting. And the delisting is also another part. It's very simple. Delisting usually is announced for a specific date in the future, and investors are notified. So basically, whoever has shares has to sell them before that deadline, uh, and then the stock will cease to exist, or the ETF will cease to exist on the market.
With Kuwait having a relatively limited universe of listed companies, what are your thoughts on the most effective ETF structure? Would a total market ETF be preferable, or would a premier market-focused ETF make more sense? Or do you see stronger investor demand for broader exposure through ETFs tied to assets like gold and other commodities?
Yeah, no, absolutely. So basically, look, all of the above. As I mentioned, there's 17,000 ETFs in the world, of different flavors and different exposures. It's just a building block for an investor to use to be able to architect a specific exposure that they want in their portfolio. And that's the beauty of ETFs. So anything that you see could be beneficial for investors is a go. Now, for the market, if you're talking about Kuwait, I think you should have both total exposure, and then if you're able to dissect the market into some thematic or something specific, then also that could be interesting as well. Depending on the number of stocks and the liquidity and the size and all these things that needs to be studied, we're happy to help. Please, you can scan that barcode that you see in front of you, and please feel free to get in touch, and we can help you. We can happy to help you through that process. Basically, investors want to see choice, and they want to see a number of ETFs, and they want to they want to see a variety. It's not just like launching one or two or three ETFs and that's it. No, like investors want to see 10 and 20 ETFs basically on the market and be able to have a choice and move from one to another so they can get fully engaged into ETFs. Now, uh, on the other question, definitely gold is now one of the number one trades that is coming out of the market. And by the way, there's only one gold fund in Saudi and it tracks the Dubai gold price instead of the global. So there's an opportunity there. Silver as well. We're seeing, and if you look at the gold Sharia compliant funds like Invesco Physical and Wisdom Tree Physical and DWS Physical that are attracting big inflows, please visit nukoud.com, take a look at the Sharia compliant report, or take a look at our gold reports, and you can see how much interest there has been in gold, especially in the last 2 weeks. We've had a tough year for gold, which came down from 5,500 down to 4,000, and now all of a sudden it's back to 4,700, and we're seeing big central banks like China and Korea buy, and you can track all this and see all this news on Nukoud. And so definitely, also what we're seeing trade in the region is thematic. People love thematic, quantum ETFs, AI ETFs, US growth ETFs. And these people like to trade them, especially with the market as well. So there's a lot of opportunity here for investors to trade, and they just need a variety and different ETFs. So the more the merrier, in my opinion. It's an investment getting into an ETF industry, and we're happy to help. Please scan the barcode and get in touch.
I'm sorry, but I have to take the last question for the sake of time. For an ETF, how is a NAV error assessed for materiality, and when does it require correction, disclosure, or compensation to affected investors?
Of course, NAV is a very important part. This is your accounting cut that happens on a daily basis that determines your return, that determines your money, right? That impacts your money immediately. So this is one of the most important parts of the ETF ecosystem. And if we don't have confidence in the NAV, then this whole ETF thing is not going to work. And basically, any error in the NAV will be immediately corrected and disclosed, and everything needs to make sure that the investors know it happened, and make sure that the investors are getting what they're supposed to get in terms of monetary compensation to make up for the difference in the nav error at least. And so it could come from multiple different directions. It could be an error. It could be, just it's nav, as we mentioned, is a simple stock price at the close times the weight, right? And then this is how you get the nav. And if there's any error in the price or the closing price or the actual weight, number of shares, etc., then that will lead to wrong nav, and that will lead to a correction and a compensation and a disclosure.
Thank you so much again, Anthony. Thank you everyone for joining. I hope you found this webinar informative and look forward to seeing you in future events. Thank you.
Thank you.